Hello everyone, and welcome to this session in which we would look at the statement of retained earnings, and also we will briefly look at the statement of equity or the statements of stockholders equity. Now keep in mind, retained earning is only one part of that statement. Although it's only one part, it's an important part. It has its own statement, then it can be integrated in the statements of stockholders equity. Now when we say retained earnings, what do we mean by retained earnings? Well, retained earnings is a cumulative account. Cumulative means it stays with us from year to year over the years. And what do we keep in retained earnings? Think of it, when we start a company, retained earnings is zero. Then as the company operates and generate profit, generate income, retained earning goes up. So one thing we need to know, net income bring up retained earnings. Then the company might distribute some of that profit to shareholders in form of cash dividend, in form of stock dividend, which are topics that we discuss in this course. When we pay out dividend, retained earnings go down. So net income bring it up, retained dividend brings it down. Now, if we start with zero, plus net income minus dividend will give us the ending retained earning for a particular period. Now, this ending retained earnings becomes the beginning retained earnings of the following period. Now, what I just said is net income and dividend influence retained earnings. Are these the only two things that could influence retained earnings? The answer is no. There are other things that could influence retained earnings. Like what? Like if we made an error in the prior period, and we'll see this in this session, we'll have to adjust retained earning either upward or downward. And there are other transactions that could affect retained earnings. For example, we saw in the prior session when we sold treasury stock, sometime we have to book the loss, in quote, the loss in retained earnings. Anyhow, the best way to look at retained earnings and explain it a little bit more in depth is actually look at actual numbers, look at the structure of it. Then we would look briefly at the statements of stockholders equity, and we will work a multiple choice question at the end. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. So let's start by looking at a statement of retained earnings with actual numbers. So things will start to make more sense when we use numbers. You have the company name, the name of the statement, and for the period of December 31st, year XX. So what you do at the beginning, you start with beginning retained earnings from the beginning of the year, which is what? This is the beginning of the year is the end of the prior year. And we happen to have in that account 50,000. So if we're looking at a T account, let me show you the T account. So this is the retained earnings, and we have $50,000. Now the company generated $30,000. $30,000 would increase retained earning, net income would increase retained earning. Then the company paid dividend of $10,000 less dividend. This is the dividend. Now, if we take beginning plus net income minus dividend, we end up with $70,000. And this is the ending retained earning. Now, this ending retained earnings will become January 1st, year 20x1, beginning next year, 70,000. Now, this company, what they did, FYI, they paid 10,000 out of the 30,000. we say that they have a payout ratio of 30%. So this is the basic structure of a retained earnings statement or a statement of retained earnings. Is this the only thing that you could see on the statement of retained earnings? No. Sometimes what you could see on statement of retained earnings, adjustments to retained earnings. What do we mean by adjustments? Yes, net income and dividend are the main factors that changes retained earning, but we could have other adjustments. What could be other adjustments? Let's assume the prior year we made a mistake. A calculation mistake, a mathematical mistake, a misapplying of accounting concept. There was some mistake of some sort, so there's an adjustment. Where do we book this adjustment? We book this adjustment in retained earnings. So why do we have to book it in retained earning? Because if the adjustment affect an expense or revenue, both of these accounts are closed out. So we cannot go back and change them because they're closed out. To what account? To retained earnings. So what we do is we change retained earnings. So if an expense was incorrectly reported, the beginning retained earning will be adjusted. Same thing with revenue. This ensures the financial statements are reliable. The best way is to take a look at an example to show you how we do this. So let's take a look at this statement of retained earnings that we looked at initially, but we added here an adjustment. Let's take a look at this adjustment. So we started with 50,000, then we added correction of a prior period error. Expense was overreported, so we reported more expenses in prior year. So what do we have to do? We have to add 5,000 to retained earnings. So the new retained earnings is 55,000. Now this is the new adjusted beginning retained earning. Then we add net income minus the dividend, and the ending is 75,000. So something else that could affect retained earning is correction of prior period error. That could be a math, misapplication of GAAP, some sort of an error. Another thing you need to know about retained earnings is sometimes retained earning can be restricted by legal requirement or contractual obligation. For example, if you want to get a loan from the bank, they might say, well, you have to keep your retained earning always at $1 million. So you cannot distribute dividend because it's contractually obligated, or sometimes it's within the company. There's some sort of a legal compliance that you have to comply with, or the company wants to restrict it internally for expansion purposes. So a company might be restricting from buying back its own stock beyond its retained earning, because beyond a certain amount. Why? Because if somebody lend you money, they don't want you to be using any profit to reward the shareholder. They want you to restrict because they want to be paid first. So bank can impose restriction to ensure the company retain enough earning to meet its obligation. So the bank can, for example, this is a contractual obligation where they can restrict it. And certain companies legally they have to do so by the industry. For example, the banking industry they have to follow certain standards. Statements of stockholders' equity is a broader view than the statement of retained earnings. So the statement of stockholders' equity include all equity. Retained earning is one aspect of equity. It doesn't only include equity, it includes other components like common stock, additional paid-in capital, other factors as well. So it also includes the addition to net income, the issuance or repurchase of stocks, and payment of dividend. So each of these actions impact the various components of equity. Net income, issuance of stocks, repurchasing of stocks, payment of dividend. Therefore, the statements of equity is a more comprehensive. So let's take a look at it. So you have the company name, the statement, and the period. And look, this is the beginning balance. The beginning balance for common stock, additional paid-in capital, retained earning, accumulated other comprehensive income. Don't worry about this. You would learn about this in intermediate accounting, and the total. So all these combined equal to 210,000 in stockholders' equity. So the statement of retained earning is only one part of statements of equity, because the statements of equity include other things. So this is the statement of retained earning I highlighted in yellow. Okay, which let's go over it first, because we already did cover it. Beginning 50,000 plus the correction. This is the adjusted plus net income minus dividend. So plus net income minus dividend equal to 75,000. We're going to do the same thing with each column. Common stock. We started with 100,000. Then we had no adjustment to common stock. Usually there's no adjustment. Then we issued 20,000 new shares. Then the ending balance is 120. So this is we did the common stock. Paid in capital, usually hand in hand with common stock. We started with 50, no adjustments. Usually there's no adjustment to this account. The adjusted balance is 50. We issued 10,000 of paid in capital, just like with the common stock. The ending paid in capital is 60,000. So we did common stock, additional paid in capital, retained earning. Accumulated other comprehensive income, don't worry about this. It's an equity account. We started with 10,000. Then we had an adjustment. We added 5,000. Don't worry about what that adjustment is. We end up with 15. Now we can go across 120 plus 60 plus 75 plus 15 equal to 270. So the total equity is 270. Other comprehensive income is 5,000. Dividend is 10,000. Net income for the year is 30. This is going across. Issuance of stocks 30. Adjusted balance to 15. Correction was 5,000. Again, we can go like this. 210 plus 5,000 equal to 215. We issued stocks. Net income increases equity. Dividend reduces equity. We had comprehensive income of 5,000. That's equal to 270. So the statements of comprehensive income is an inclusive. It includes everything, not only retained earnings, but retained earning is an important component of statement of equity. Let's take a look at this multiple choice question from farhatlectures.com. In which of the following statements are prior period adjustments reported? So we're looking at 4 options, and in one of them we include prior period adjustment. Prior period adjustment is an adjustment that we have to make because we made a mistake of some sort. Where do we book this mistake? Is it in the balance sheet? Is it in the multiple step income statement, statement of cash flow, or the statement of retained earnings? And the answer is, if you have any prior period adjustment, because most likely it will affect a revenue or an expense, it will be booked into retained earnings. Now, retained earnings is eventually a balance sheet account, but it will be booked. It will show, the adjustment will show in retained earnings. What should you do now? Whether you are an accounting student or studying for your accounting professional certification, CPA, CMA, or anything else, you want to go to Farhat Lectures, look at additional resources, multiple choice lectures, exercise that will help you. Invest in yourself. That's the best investment you can make. Good luck, study hard, and of course, stay safe.